Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Bank of America Corporation, ticker BAC. Over the next 5 minutes, I'll break down my thoughts on both the business quality and the valuation for this company. Now, Bank of America is, of course, a bank. It is one of the largest banks in the United States. I don't even know if I need the business description to tell you that. Has a high beta, high share turnover. Serves 67 million consumer and small business clients, 41 million active users on its digital banking platform, 16,000 ATM, 4,200 retail finance centers. This is a global bank. This is a huge bank. You see $282 billion in market cap. So we need to understand that when we're looking at this company. Now, one thing we want to note immediately is return on equity. You can see they lost money only in 1 year of the last 20 years. That's actually really good, especially because that 1 year was 2010. This was the banking crisis where their returns dropped from the 17% return on equity range down to 2% 2008, 3% 2009. Lost a little bit of money of 2010, but overall very good ability to stay profitable throughout most of that time. 19 out of 20, very good from a standpoint of returns. However, returns on equity here are very, very low. They were great in up till 2006, but starting in 2007, they were crashing. Let's see when they become acceptable. So you can see in 2018, we finally hit double-digit return on equity, 10.5%, 10.3% in 2022. 2020 is 6%, 2021, 11%. So the last 4 or 5 years have been acceptable. You're now getting in that double-digit range. That's where you want to be for return on equity, especially as a bank. But overall, this history doesn't look great. Now, however, it has been increasing over time. So it could get back to where it was before, especially if their incremental returns on capital are much better. If interest rates continue to rise, you might see that net interest margin continue to rise, and things could get better here. So 10-year median returns, return on assets of 0.8% is just simply too low for me to get interested in a bank. I want return on assets of at least 1% at a minimum, because a 10x leverage would bring you to a return on equity of 10%, but return on assets getting into that range of 1.5% to 2% is where you get really attractive from a bank. So from a bank, I'm not as interested as it is right now. Now, price to book 1.1, that's pretty reasonable. With this return on equity of 6.7%, if that's what's going to be sustainable, I'd want to pay less than book for this bank. But it's possible that they could be going higher than that. When you see earnings assets growing 4.8%, deposits growing at 7.2%, this suggests that if they can make loans, especially at these higher interest rates, their profitability should increase substantially. They're basically flat on net income over the last decade, which is pretty poor. It explains why the price to earnings ratio is 9 here. So everything seems reasonable, but nothing's great here. There might be more to learn as we dig further in, though. If you're enjoying this video so far, please hit that like button, and don't forget to subscribe for more investing content and for the rest of the S&P 500 series. When you ring the bell, you'll get notifications as I upload new videos. Now, as we dive in further, we can see that their loans to deposits have dropped over the decade. So they've been able to increase the return on equity despite the fact that they have a lot of open ability to make more loans. If they're able to make more loans, especially with a tight economy right now, then they could really drive those return on assets and return on equity to a higher level. Very, very good there. Let's see, go to the income statement. You can see that net income has just been growing massively over time. EPS has grown massively over this last decade. They've been buying back shares, which is nice to see from the bank standpoint. If you're not able to grow, at least buy back those shares to boost the EPS. Net loans has not grown much. And so this is really the kicker. So you've been able to grow your deposits basically 2x from 1 trillion to 2 trillion over the last decade, but you've basically had very little loan growth, and that's been a big driver of their inability to boost their earnings. Cash flow statement. You can see constant share buybacks. I really like to see that. You do have some stock compensation, but it's always substantially lower than share buybacks. They're putting basically all of their cash into cutting back their common stock. That's a very good way to manage a bank that's having trouble growing. So for me, There's some interesting pieces of Bank of America. I like the trend. If they can continue this trend of growing the return on equity, that means that the incremental returns on equity are high. And that means that the incremental returns of equity are actually higher than 11%, which is very, very attractive for the potential future of this company. Now, to me, I have banks that I'm interested in that are much, much smaller. But if you have a lot of assets, especially if you're looking at large cap banks, Bank of America is actually quite promising. If they can return to these 16, 17%, 20% returns on equity, then you're going to be very happy as a shareholder of this bank, especially if you can buy at this price to book of 1.1. So thank you for listening. Don't forget to hit that like button. Please subscribe and ring the bell so you can get notifications as I keep uploading new investing videos each and every week. Thank you.